Unit 6, Government and the Economy. In this unit, we're going to talk about what is the proper role of government in the economy. How much involvement should they be in there? Should they be involved? So in Unit 6, we will be talking about the government and the economy. The first chapter we're going to look at in this unit is Chapter 14, which is Taxes and Government Spending. The question we'll be answering is how can taxation meet the needs of government and the people? So we're going to talk a lot about tax brackets in this chapter. We're going to talk about what type of taxes are out there, how they're spent, and some reform that is out there when it comes to taxes as well. And we'll be looking at it just the government involvement and how they spend money when it comes to taxes. So we're going to start in Section 1. What are taxes? What are the features of a tax system? Well, first question we need to answer, is it constitutional in order to tax its citizens in the United States? The question is yes. It is in the Constitution, and it is created by the legislative branch to tax its citizens. Legislative branch is Congress. Article 1, which only deals with the legislative branch, in Section 8, it talks about the ability to raise money, which basically means that the ability to tax its citizens and people that are making transactions, buying, selling things in the United States. This was a huge piece in the Constitution because our governing document we used before the Constitution was the Articles of Confederation. And one of the biggest flops with the Articles of Confederation was they could not mandate taxes. They could only recommend or ask for money to be spent or raised by the states to be donated to the government, but they could not actually directly tax its citizens. So that's part of the reason why we had to go towards the Constitution and have the power to tax. The United States was so upside down with its money and its debt under the Articles of Confederation. We would actually have pirates that would board our ships and then send out ransoms to the federal government saying that if you want your crew back, your citizens back, you're going to have to pay us. And there was nothing we could even do. We couldn't even pay them back because we just had no money. So yes, the Constitution does cover the power to tax. So what is a tax? It's a required payment. A required payment to a local, state, or national government. So with that, that means there's usually different tax levels. National means everyone's going to tax on it. State is just based on if you lived in that state, and local, that would be your local city that you live. They would have their own taxes as well. The money that is brought in from taxes is known as revenue, income received by a government from taxes. So when we refer to revenue, that's what it is. It's income received from that. In the Constitution, this clause gives the power to tax for the common defense and general welfare, which is so broad that you could pretty much say anything could be created for a tax for this reason. But for the common defense and general welfare. So the idea for the common defense, that's military, that's our borders, that is National Guard, that is for defense reasons, for the common defense. The other one is general welfare. This is providing aid in disaster. This could provide relief for different parts of the country. This could be, general welfare could be raising money for education. It could be anything that's involved with this. But as you can see, it's so broad for those terms to be called that. All right, so economists put taxes into three different categories, three different tax structures. The first one we have here is a progressive tax. This tax is based on the amount of income that you make. So the more money you make, the higher taxes you have to pay. This is known as an income tax or progressive tax. This is a chart that rated different countries to kind of see when it came to taxes throughout the world, where are the lowest amount of taxes and the highest. Obviously, Mexico is lower. And then once you get to the top here, you kind of notice that Sweden, Denmark, and Germany are the highest. In the U.S., we're kind of in the middle. We're more on the high side probably. but Sweden, Denmark, and Germany. Now, Sweden is the country that usually gets glorified for its socialist beliefs that, Medicare or free healthcare and also free education for college students. But their taxes are extremely high. I mean, it's 31.1%. I want to show you something real quick when it comes to Sweden. So for this one, when this graph was created, it was 31.1%. If you look at this graph here, this is income tax in Sweden over the from 2006 to the last 10 years. As you can see, it's been bumping up dramatically, and now income tax rates are up to 57% in Sweden. Now, I don't know how much bracket of how many people actually pay that 57%, but that's extremely high. I mean, that's 50% of the year of your taxes going straight to the government, which is extremely high. Here's some other taxes. Corporate tax is pretty high. Personal income tax, sales tax, Social Security. All these are extremely high compared to what we pay in the United States. If we go to the 2015 tax brackets, income tax brackets for the United States, you would find that our highest tax bracket is 39.6%. So compared to Sweden, which is at 57%, we're at 39.6%. So our taxes are still pretty high. If you look at the 2006 tax brackets, this is the information that you'd find. The highest we get is 39.6%, which is better than Sweden, but that's 39.6% of the year that people are working for the government. I just quickly went to this article to find out what are some of the candidates saying about their taxes and what they want to do. Well, Hillary Clinton wants to raise taxes on the 1%. And what that means is that if you make over $732,000 a year, and if her tax bracket goes through, that means now $78,284 of additional tax would be taken away from your income. Now you look at that and you say 732, 78,000 more taxes, that's a pretty good deal for them. Well, the point is though that the people that made $732,000 earned that. So why should they have to be penalized for making additional money? And we talked about this before on taxing the rich, on how it doesn't really help the economy when it comes to this. Now there's loopholes out there, and I understand that with corporations and they're able to evade the tax codes. That's not a problem of these corporations. That's a problem with the government with having loopholes. I looked at some of the other candidates. Bernie Sanders, he had a plan as well to increase taxes on the 1%. And his ideal, he got some feedback from Nancy Pelosi, who's the minority leader of the House, saying that they would never go for his plan because it's too expensive. If we go down to Ted Cruz, he has something called a flat tax rate. And he says that we're just going to tax everyone at the same individual income rate, which would be 10%, and making it fair for everybody when it comes to this. He then goes on to talk about that he would then have, you can't really see it in the screen here, but a 16% business flat tax. If we go back to the Sweden rates, their corporation tax is 22%. So with that, our business tax would go up, but it's eliminating a lot of other taxes that are already out there for you. John Kasich, he had another plan. Basically, he'd forgive all corporations if they'd come back to the U.S., and any profit they bring back with them would not get taxed. Donald Trump, he has a plan. He would not eliminate the income tax, but what he would do was anyone that makes $25,000 or below would not have to pay income tax. If you're a couple, $50,000 or below, you would not have to do that. He says that the highest individual income tax rate he would do is 25%. And again, if we go back, it's at 39.6. So if he cuts that rate down, that is going to allow everyone across the board to make more money. So it's an interesting plan. Then it has the rest of the candidates here. But I thought it was just interesting about the remaining people that are in the election and their plans when it comes to the tax brackets. All right, back to the notes here. So that's a progressive tax. Let's look at the next one. The next one is proportional tax. Proportional tax is which the percent of income paid in taxes remains the same at all income levels. So this would be considered something like a flat tax. A few years ago, there was a presidential candidate by the name of Herman Cain wanted to implement a flat tax, and his plan was known as the 999 plan, where you'd have 9% going to income tax, 9% going to sales tax, and 9% going to corporate tax. So making it more fair across the board. This is the same idea. So if we look at these different incomes of these three individuals, $20,000, $30,000, and $50,000, we have a flat tax of 10%. Everyone pays their fair share when it comes to this. And it is a pretty solid plan when it comes to this. Here's the problem that we find if we try to implement a proportional tax for income. A lot of money that we currently have funding for comes from these income taxes. And if we eliminate that, that would then result in less money available to the government to spend for government programs, which in a sense is a two-edged sword. Yes, that would decrease the size of the government. The other side, it would decrease government programs, which, is not a bad idea either. So it's a plan that we'll be talking about as we go through this. The next one is regressive. This one, percent of income paid in taxes decrease as income increases. So this is what we mean by this, okay? So let's say you have $10, and then we have another individual that has $20. If there goes out to be a tax on these individuals, when it comes to this, let's say that it's the tax is going to be $10. Let's say gasoline. Let's use that. Let's say gasoline is going to have a tax of $10 on it. Well, that means let's say that if I'm making only a certain percent, if I'm the lower income, 10% or $10 is going to take more from my income that I'm making. Versus let's say I'm making more money and there's a $10 tax on gas, it's going to affect me less because I have more income. So if it's someone making $20,000 and someone making $80,000, it's a regressive tax. It's going to affect the person more that's making less money than the individual who's making more money. So that's what a regressive tax would be. Now we have something called a tax base. In the tax base, there's 4 different categories that are drawn to tax on. The first one is an individual income tax. That is based on a person's earnings. Corporate tax, this is companies' business or whatever profit they make, they get taxed on that. A property tax, this is real estate, this is houses, any property that is owned gets taxed. And then there's sales tax when it comes to this. Sales tax is on goods and services. Now, some states are more lenient than others when it comes to sales tax. Some states do not tax food or essential items that would be out there for its citizens just because they look at it, it's a need, and we shouldn't be taxing that. So there's the 4 different areas for the tax base. Who bears the tax burden? So we would use a supply and demand analysis to figure this out. So we have 2 examples here, okay? We have gasoline and red markers. Remember in a past chapter, we looked at something that's inelastic and inelastic and elastic. Inelastic means that we're not going to look for a substitute because there is no other substitute or we're not affected by the price increase. Elastic means that the price is so high that we look for substitutes and we'll go with something else. The same thing when it comes to the product market. And we've talked about this before. So let's say that a tax on gasoline is increased by 20%. So let's say a gallon of gas is $1.50, and then now 20% tax is actually put on this. Governor Mark Dayton is actually wanting to add an additional tax to gasoline because gasoline is cheap right now and we could use another form of revenue to the state of Minnesota. You could agree with that or disagree with that, but that's just actually taking place right now. So let's say that the governor, wanted to implement a 20% tax on gasoline. So what would that mean? Well, 150, 20% tax would mean that would be 30 cents. So what is the gas station going to do? Are they going to include the price onto the gasoline, or are they going to eat the tax, meaning that they will cut away from their profits? So we have to look at the item. Is gasoline elastic or inelastic? And the answer would be inelastic because we do not have a large amount of substitutes out there for gasoline. Unless you want to walk or have an electric car, but electric cars are still at the price point where it's too expensive for the majority of people to own. So the gasoline, the gas stations, instead of them having to break away from their profit, they would then just include the price to be $1.80 instead of $1.50. So $1.80 would now be the new price, and the consumer would be the one that would have to now pay more money for gasoline. All right, red markers, quicker here. Let's say it's $2 for a red marker, and let's say they want to up the price in markers. Markers are just, let's say there's a hazard to our health, or they're just red markers and no one likes them, so we're just going to decide that we're going to put a tax on red markers. Okay, so if I'm a red marker manufacturer and I'm selling at the store, if I have a 10% tax, that's going to be an additional 20 cents onto my marker. Now, as a result of that, is the store going to just break away from their profit from red markers, or are they going to increase the price? Question comes back to, is it inelastic or elastic? Well, is there a substitute for red markers? The answer would be yes. We could use a green marker or a black marker or whatever we want to use when it comes to this. So, who is going to bear the additional tax? That would be the store. So now, instead of them pricing it at $2, they would keep it at $2, but now they're losing 10% of their profit on the red markers. So when we see these tax burdens, when they talk about increasing taxes on corporations or products, it doesn't mean that more revenue is going to be in. Sometimes it means that the consumer or the citizens are going to be the incidence of a tax. And that means that the individual will have the final burden of a tax. So, who's bearing the tax burden? In the gasoline situation, it would be the consumer. In the red marker, it would be the supplier or the store. So the incident of a tax, who has that final burden of a tax? All right, characteristics of a good tax. 4 areas: simplicity, efficiency, certainty, and equity. In order to be considered a good tax, these are the 4 qualifications that it needs. So, quickly here. Simplicity. Simple to understand that people can easily record and pay taxes on a predictable schedule. Next, efficiency. Assess and collect taxes without spending too much money or time. Certainty. When a tax is due, how much money is due and how it should be paid. And equity, meaning that it's fair. It's a fair tax. So if it's not simple enough to understand by anybody, and if it's not efficient, if it takes hours and hours to figure out, and if you're not certain on when something is due, and if it's not fair, it's not a good tax. So these are the 4 areas that we talk about this. Rand Paul, who was a candidate for the Republican Party, dropped out a few months ago now. He actually had this video attacking the tax brackets and how they work out. And he has this video where he has this chainsaw and he's saying, we need to cut taxes in half. He's like, with my plan, I can get the entire tax system down to 1 page. The current amount of pages that are a part of the tax system is 70,000 pages. So if we look at that, is it simple? Not really, because it's 70,000 pages. Is it efficient? Absolutely not. There's probably loopholes into there, so the certainty is not there. And equity, it's pretty hard to monitor 70,000 pages to find this. So the current tax system that we use is not a good system. We do need reform when it comes to that. And Rand Paul was one for getting rid of the IRS and making the system simple enough where you could fit it on one page. Now, one page, that's pretty extreme, but even if you get down to 10 or 20 pages, that would be a lot better than 70,000 that we use now. All right, a couple more slides. 2 more slides. We have now the question of determining fairness. What is fair, a fair tax for everybody? And then who gets the benefit of it? Well, there's this principle called the benefits received principle. And the idea is that a person should pay taxes based on the level of benefits expected to receive. So, let's use gasoline. The gasoline tax. If you drive a car, well, that means you're going to use the roads and highways. And as a result, you would pay taxes on the gasoline. And then as a result, you can drive on the roads. This would be a benefits received principle. You get to use what you pay for, which is an excellent idea. The other principle is ability to pay principle. Pay taxes according to their ability to pay. Now, this is where there's a lot of debate with this one. Who gets to say that some people get to have the benefit of the ability to pay principle and those who do not? So this is where the 1% of those making the top incomes in the United States usually get attacked, because they look at this as, well, they're making so much money, why should they get any of the benefits? And you know what? Most of those people in the 1%, they would agree to that. They would say, okay, we don't need to have all the amount of money that you are giving. So the ability to pay principle is based on that. The problem is that a lot of these individuals are being forced to pay it, and they would rather do it and have a choice on where they'd pay this money. So the ability to pay principle, it's a hot topic that is out there. Who should get to pay, who should not get to pay when it comes to this. All right, last slide. So balancing tax revenues and tax rates. So what is a good tax? Good tax generates enough revenue, but not too much. The state of Minnesota, they, over the last couple of years, had a surplus of money left over, which we look at that and we would say that's really good for the state of Minnesota to have leftover money at the end of the year. Here's the problem. That means that we were taxed too much. They took too much money when it came to this. And as a result, now we have this extra money. So now the state legislative branch and the governor are arguing, what should we do with this extra money? In my opinion, give it back to the citizens. They owned it. That's their money. Give it back to them. Or you hold on to it for emergency fund. You don't spend it. Well, there's quite a few different branches and different government agencies that want this money. They really need to hang on to it in an emergency case if we ever need it. But probably what will happen is that the money will get spent not wisely and it's a waste. So a good tax generates enough revenue but not too much. That is the end of section 1 in unit 6 of chapter 14, taxes and government spending. If you have any questions about it or concerns or anything you want to ask me, please let me know.